My name is Alia Gerard. I'm the Member Services and Market Programme Manager at UCSIF, the UK Sustainable Investment and Finance Association. I believe you heard my CEO speak earlier this morning. I'll be chairing this session, which is entitled Sustainability Mission Possible. We have a number of fund managers here today to talk about how realistically investors can make the transition to green and sustainable business possible. We'll be looking at the methods that they can employ and the investment case to be a part of that solution. Just before we start, a little bit about UCSIF for those of you unfamiliar with us. We're the sole UK-focused sustainable finance network, so we seek to convene the sector through our events, through public campaigns like Good Money Week, which we're right in the middle of, and we support our members, including banks, fund managers and indeed financial advisors, in growing and developing responsible finance. It's brilliant to see so many of our members here today, but for those of you who are curious about engaging with us, please do come and say hello during one of the breaks. And without further ado, I think I'll kick off. So this is Mike Appleby from Liontrust. Mike, when you're ready.
Thank you very much. So, is this mission possible? It's very easy sometimes to wring your hands and try and stop bursting into tears at the state of the planet and everything. But I'm suggesting that positive change is very possible. And it is happening already and has been happening for a long time. So, for example, let's look at particulate matter 25 microns. So these are tiny bits of dust that are really, really bad for you, that generally come out of the back of diesel cars, etc. And look at how the number of hours that it's above healthy concentrations in London has changed since 1992, since I basically moved to London. Although you wouldn't believe it reading the press, there are 30 times less PM25 concentrations in London than there were 30 years ago. You're not reading about it anywhere, no one's going on about it. The particulate matter dust in London, which although everyone's whinging about it now, 30 years ago no one could conceive that it would be that low. Now I'm not suggesting that there aren't major challenges and we've got to do things really, really quickly. But I think you've got to realise that positive change is happening and there are things going on. To stay positive, this is a positive mission. Another area, since I started driving, road traffic accidents in the UK have fallen by 75%. And that's with an increase in traffic and the number of miles driven, a considerable increase. So there are things that are getting better. Let's not get too bluesy about it. And I want to talk about how important it is to look for the potential winners, because if there are companies that are innovating and enabling us to move towards a more sustainable way of developing, those are potentially really interesting companies because they're going to benefit from big secular demand for basically making products that we need more of. So I'm going to talk about climate change. We've all heard about climate change. The idea that we've got to get to basically zero carbon dioxide, and the sooner the better, is quite hard to get your head around. So what I wanted to do was just do a back of the envelope exercise and think about the average person in the UK. What do they emit and where do their emissions come from, and how hard or easy would it be to make a material impact in reducing those emissions? Because let's think about practical things here. Okay, so the average person in the UK emits 10 units of CO2, tons of CO2 a year. These are the direct emissions. They also have indirect emissions from what we buy, consume and what we eat. That's 3 to 4 tons on average. Let's just concentrate on these 10 tons. It makes the maths easy. I just want to concentrate on those direct emissions for now. Where do they come from? About 15% comes from the electricity used in the home, about 25% comes from heating the home, and about 30% comes from driving an internal combustion engine car, and about 30% comes from flying. Now, those numbers might surprise you. They surprised me because the airline industry is quick to point out that they're only responsible for 2% of global emissions. But hardly anyone flies, except for people like us. So that 30% in the UK for flights is, I thought was quite an interesting observation. Anyway, so what are some simple things that we could do today to reduce emissions? I'm not waiting for someone to invent, some magic genie or whatever. What could you go out and do right now? And how would it make any difference to your emissions at all? And we can argue about how I've accounted for this, but let's not. You can come and beat me up at the end. But I'm just going to do a simple back of the envelope thing to work out, how hard this would be. First thing, electricity, pretty simple. Go on a website, switch to 100% renewable energy tariff. All the energy you use is matched by an equal amount of renewable on that side, and that would reduce the emissions from the electricity considerably. And I'm going to say that reduces it by about 14% of your total 10 tons that you're emitting. The second bit, most homes are very poorly insulated. And a few hundred quid with roof, help me out, cavity insulation, and maybe some smart things in the rooms that make sure you're not heating rooms that you're not in, etc. You can easily reduce that heating bill by about 20% over the course of a year. Saves you money, only reduces your total direct emissions by about 5%, but that's handy, it saves you money. Then secondly, if you were to buy your next car was an electric vehicle instead of an internal combustion engine and you were charging off renewable stuff mainly at home, that would reduce your emissions by about 17%. And if you halved your flights, or if you really had to fly offset, I know, don't shoot me, but just let's run with this for a while, that would be about another 17% reduction. You top all that up, it's over 50% reduction in your direct emissions. And there are a couple of observations that I want to make about that. The first one is none of those require any real major personal sacrifice. We're not asking anyone to go and live in a cave. And actually, a lot of these things are either cost neutral or save you money. There's one exception, which is the electric vehicle, which is my second observation, is that the costs of replacing an internal combustion engine with an electric vehicle are falling every year. Over the next 18 months, there are 3 times more electric vehicle models than there are available today. You won't have to be a hedge fund manager dropping 90 grand on a Tesla to be able to get involved in electric vehicles. There will be ordinary electric vehicles for ordinary people. They might not be as snazzy, but they'll be a lot more affordable. So it's actually, I think, remarkably easy to make a lot of differences using technologies that are available today. And companies that are doing things that help us to accelerate towards a lower carbon transition are a really interesting place to look for investments. And it's a very compelling investment opportunity for many people because they're like, hang on, if I can invest in companies that are part of the solutions to some of the problems we've got, and if I can make decent investment returns, I really like that. Why wouldn't I do that? The second bit is, let's just stick with climate change for a minute. If we take the global average temperature, let's set it at 0, as far as a change from pre-industrial levels. The global average temperature has already increased by 1 degree centigrade now. We're trying to limit it to 1.5 to 2 degrees. That's the Paris Accord. Current policies, if they are enacted, will get us to about 3.3, maybe 3.5 degrees. So there's a massive gap. 1 degree might not sound like a big gap to you, but it's a big gap in terms of the amount of emissions that need to be reduced. And so we can expect huge amounts of ever-tightening regulation to reduce carbon emissions, which will benefit these companies that are helping us reduce emissions. So, quick summary. Clearly renewables are a winner. But interestingly, if we woke up tomorrow and the world was running on renewables fully, we'd be a quarter of the way there to decarbonisation. It's not just about renewables, although they're really important. And to bring everyone up to date, I still get people that say renewables are really rubbish, they're really expensive, and they're basically shit. So why are you investing in them? Well, the news is that 15 years ago when I started here, yes, solar was the most expensive way you could possibly generate electricity, required huge subsidies, so wind less so, but similar. Until we fast forward today, and in many areas, they are the cheapest way to generate electricity today. The cheapest way to generate electricity in the UK today is onshore wind. So unfortunately, we're not really incentivised to build any at the moment, but let's get the current business off the table of government. Hope we can get a move on with it. And in the US, for the last 12 months, the cheapest form of new electricity generation by a considerable margin, much cheaper than gas-fired power stations, even with really cheap fracked gas, is solar by a considerable margin. So there's some really interesting things that are going on there. There's going to be huge change in transport. Unfortunately, I can't go into all of these things in a huge amount of detail, but in transport, there are huge opportunities for companies that make things that you need more of to reduce emissions. Lots of semiconductor chips that go in there to manage the powertrains, etc. And there are some really interesting companies that are benefiting because of demand for what they make. The final bit I want to make, and this really isn't about our investment process per se, but it's just about any investment. We think there need to be 4 aspects that need to be right for it to outperform. The first one, it needs to be the right side of the trend. I've spoken about that. Avoid the companies that are going to be regulated out. The second one is that by analysing how they manage their environmental, social aspects of their business and how they're governed, can give you a good proxy for the quality of management that are more likely to deliver in navigating through this. But those on their own, those 2 sustainability things, are unlikely to deliver good investment returns. You also need the company to make money. You want the company to have, I'll call them business fundamentals. They're able to generate good investment returns because they're doing something that's hard to copy. And then finally, you want to buy these companies at the right price, where you're not having to make too heroic assumptions about what they might be worth in 3 to 5 years' time. And it's when all 4 of those aspects are aligned, that's what I would determine, or we would define as a sustainable investment. So it's good to talk about trends, but it's got to affect the investment decisions as well. Okay, I think I've gone.
That was 10 minutes to the second,
right.
So thank you very much. Mike, thank you. Moving along to Alex Wadani, Deputy Fund Manager and Global Equities Analyst at Saracen and Partners. Alex, when you're ready.
Thank you. I'm going to talk about the steps that we take to find industries that are sustainable, and then within that look at companies that have sustainable business models, whilst at the same time avoiding companies that are unsustainable. There is a small presentation pack on your seats, and I'll be talking to the slides in that. So on the first slide, we have here an illustration of the trends that we have identified, both positive and negative. We focus solely on the top section, on industries where we see the long-term growth rates sustainably above GDP. That is diet change, smart grids, electronic payments, zero carbon power, to name a few. Within those industries, we're looking for the companies that have the most sustainable business models, and at the same time we're avoiding those that we think are not. Because we spend our time focusing on the industries with long-term sustainable growth, we're already filtering out industries in structural decline, industries that have regulatory headwinds, industries that are falling out of favour, like coal. If we were to consider the definition of sustainable development, and that sustainable development is development that meets the need of the present without compromising the ability of future generations to meet their own needs, we look at most of the things on the bottom side there, and we can see that arguably they don't meet that definition. Now, investors and non-investors alike, attitudes have changed considerably in recent times. People want to make a financial return, but they don't want to do it at the expense of the planet. And much of this has occurred relatively recently with David Attenborough's Blue Planet, where they were highlighting the effects of plastics in the ocean. But the natural capital isn't the only capital that we consider. We look at some other capitals as well. So on the next slide, These are the 5 capitals that are the building blocks of most businesses: human, natural, social, produced, and financial. You need to have all 5 of these to build a sustainable business. So natural capital is pretty obvious. It's made up of the resources and the ecosystem services of the natural world. Items such as minerals, water, carbon dioxide absorption, and arable land. This is the sort of the starting block for a sustainable business. Unfortunately, we've started to see mechanisms that are now able to price this capital. Human capital is a social issue, health, knowledge, and skills. Without a suitably educated workforce, you're going to struggle to get a company to operate properly. And then linked to that is social capital. This is the most controversial and probably hardest to measure. There's not really much output here. But you need to encourage the development of human relationships, common values, and trust amongst your staff. Otherwise, the effectiveness of the workforce is going to be diminished. And then you have produced or manufactured capital. Items, land, buildings, transport networks, computers. It's pointless having the other capitals if you don't have the infrastructure to then turn them into a product. And then finally, you have financial capital. This is the sum of all of the capitals. And if you don't treat or manage the capitals properly, then your financial capital is going to be diminished. So then, if you want to then assess a company, you need to dig a lot deeper. Natural, social, and human capital includes many different items, some of which are more material to companies than others. So if we look here on slide 3, the top section, this is really the E in ESG. Companies impact the environment in many different ways, some more so than others. This is an area where we believe regulation is going to become more and more onerous, and the cost to companies that exploit or damage the environment will increase. And a great example here is the carbon price. It's a great example of where we as a society have put a price on natural capital. At the last count, there were 57 carbon pricing initiatives in the world. 20% of the world's emissions are covered by these initiatives, and the price has increased fourfold since 2017, and we believe the price and the scope of these initiatives is going to continue to increase. As I said, only 20% of greenhouse gases are currently covered, and it's not enough to meet the goals of the Paris Climate Accord, so there is a long way to go. If we look at the middle, this is really these are the social issues, so the S in ESG. Data here is pretty sparse, but we do have many documented cases of companies who mistreat various stakeholders. Ryanair and Sports Direct would be two examples. And then the final section is the G, is governance. And this where we as fund managers spend an extraordinary amount of time looking at a company's governance structure. Poor governance practices will often lead to the mistreatment of social, human and natural capital, which will then have an impact on your financial capital. So how do we integrate this into our investment process? Well, slide 4 shows you what we do. We use a traffic light and grading system. We score and rank all of the companies on our approved buy list. The traffic light system is pretty simple to articulate. Green is good, amber, room to improve, and then red is bad. We then give a company a grade from A to E, with E being the worst and A being the best. We look at all of the environmental, social and governance items that we perceive to be a risk to the long-term sustainability of a company. We then we put it onto a slide, and here I've given you an example of a company called Bad Company PLC. Rest assured, we wouldn't invest in a company that's this bad. But if we look at E to start with, a risk for this company we see is that 80% of their R&D capex is going to be pushing towards the extraction of more fossil fuels. As Mike has just articulated, the cost of renewables has plummeted. Will we need these expensive and polluting fossil fuels in the future? 90 million barrels of oil a day, or coal as a fuel source? Arguably, and hopefully, none of these will be needed in 20 or 30 years' time. Likewise, the Paris Climate Accord. Failure to acknowledge or change the way that you operate your business is a fundamental risk. It's a head-in-the-sand approach. We believe regulation will tighten, and that regulation is normally an increased cost for these businesses. And then governance. There's always a lot in governance, but there are some bare minimum standards that we expect companies to adhere to. We want to see an appropriately qualified board, diverse, independent. We want remuneration packages that are aligned with the long-term interests of shareholders. we want a large shareholding requirement from senior management. Without this very basic framework, and this is missing out many things, management may well be incentivized to take short-term decisions for personal gain and not in the interests of a long-term sustainable business. The next slide really just shows you how we take all of this information and try and put it into a valuation framework. What do we actually do when we find a business that has ESG risks? All equities have risks. That's why the equity risk premium exists. So our job is to cost them appropriately and to make sure that it's adequately reflected in the valuation. So here, a method we use, relatively simple. We look at the weighted average cost of capital of a business, and where there are ESG headwinds, we choose to increase that cost. So as you can see from this example, the weighted average cost of capital as per Bloomberg is 9.1%. Using this rate to discount the company's cash flows, you get to a fair value of the business of $28. Once we've made our adjustments based on all of the work that I've just shown you, we decided to increase this to 10.8%. We believe that there are risks that the market is not pricing. When you look at when you discount by 10.8%, the fair value of the business is $22. So that is a 20% reduction in the previous fair value.
2 minutes.
I will caveat that's just one of the inputs. We use many, but we've only got 10 minutes, so we'll just choose the best. The next slide really is just, what does a good company look like? Unsurprisingly, it is almost the opposite of what a bad company looks like. I won't spend too much time on this, but the next time you see a company or you see one of your managers, look at look at these aspects. Is there room for improvement? Look at where they fall short. No company is perfect, and we're always striving to get companies to improve and to be best in class. And then just finally, a word of warning. Not all sustainable companies make good investments. We mustn't lose sight of what we are here to do, and that is to protect and grow our clients' capital. This is a chart of Siemens Gamesa versus the MSCI All Countries World Index. Siemens Gamesa is one of the world leaders in wind turbine manufacturing, an industry that has grown exponentially in recent years. As you can see, the index is up more than fourfold since 2005, but Siemens Gamesa has lagged considerably. And with that, I shall pass on to Henderson.
Alex, thank you, and thank you for keeping to time. So lastly, we're going to be hearing from Janus Henderson investors. So we have Hamish Chamberlain at the end, who is you're the head of SRI, correct? And Hamish's colleague, Anna Siri, who is an ESG analyst. So Janus Henderson, when you're ready.
Thank you very much. Good afternoon, everyone. I'm going to start by talking about driving a car as an analogy for investment. And I think this is something which Mike, Alex and I all have in common, is that we believe that thinking about sustainability issues helps us make better investment decisions, that sustainability makes good investment sense. And I think underpinning our philosophies is this belief that we will generate better investment returns for people by thinking about big sustainability issues. And the way I think about it in terms of a car is that when we drive a car, you're looking through the windscreen, you're not looking over your shoulder. This industry is full of people who talk about history, what's happened over the last 10 years, 20 years, 50 years, looking at sort of financial returns. And yes, we can learn a lot from history, but what we really are in the business of doing is trying to anticipate the future. And this is where sustainability comes in, because there are these enormous environmental and social issues which are placing the global economy under enormous pressure. And we as active investors have got an important role to play in that. Now, with all this technological innovation, I'm sure many of you are also thinking about the fact that perhaps in 10, 20 years' time, we'll all have autonomous cars, and we won't be driving any cars, in which case my analogy starts to break down, because I will be out of a job and you'll be investing with a machine. But this is where I have an emphatic different view of the future, as I think sustainable investing is absolutely about being an active investor. Being an active investor involves engaging with companies. Now, there's a big issue with engagement because there are different ways to think about engagement and its role in investment. And I'll come on to those distinctions in just a moment. I'm going to sort of frame it by talking about our investment approach. Again, which has got a lot of similarities with the way Mike and Alex have spoken about investment. We talk about the 4 pillars of our sustainable investment approach. when we designed this investment approach, we thought about how do we incorporate environmental and social considerations the whole way through our investment process, from idea generation, the definition of our universe, all the way through to portfolio construction and portfolio management. So first of all, we think about environmental and social factors in relation to a company's product to define our investment universe. We have environmental and social themes to try and identify companies that are exposed to the right sort of trends, goods and services that are of benefit to the development of a sustainable global economy. And we also have very clear negative criteria. We think it's very important to be clear about what you won't invest in, things which are not sustainable. So in and amongst our negative criteria, I really enjoyed listening to Emily and Grace this morning talking about the Ellen MacArthur Foundation and also the Amazon, is that we do have very clear criteria around companies that do damage to the environment. We don't invest in meat and dairy, we don't invest in fossil fuels, we don't invest in chemicals of concern, we don't invest in industries which contribute to the destruction of the environment, such as palm oil or cosmetics and poor supply chains. We're really, really careful about the types of companies that we don't invest in. When we've defined our investment universe, we then have the next two pillars, the third and fourth pillars, which is fundamental research, which I think Alex has spoken about incredibly well. I think he's got a very good process, and we try to do similar sorts of things, which is incorporating this sort of environmental, social governance or operational analysis into our investment decisions. And then finally, you've got the portfolio construction, where we believe engagement plays a really important role. So you can probably see that we have both product and operations running through our investment process. We look at a company's product, and we also look at a company's operations. Now, the important thing from this perspective is that we're interested in investing in good companies. We want to invest in companies with the right kinds of goods and services, and we want to invest in well-managed companies. And so from an engagement perspective, this raises an interesting issue, because there are some people who would say the most impactful way to do engagement is to invest in the worst sorts of companies, the Cargills of this world, and then to agitate for change, to help them transition. And I have a lot of sympathy for that argument, and I think there are people out there who do have that sort of investment approach. I'd call it transition investing, investing in companies that need to transition to a better model. And there are people who do that. Now, we don't do that because we've already defined our investment universe through some very clear environmental and social criteria. So we're deliberately targeting what we believe are good companies on the right side of these trends. We obviously can't engage with companies that we don't invest in. We don't have a voice. However, there's still a lot of engagement to be done with so-called good companies, because the reality is that we're still a very long way away from living in a sustainable society, a sustainable planet. Every single company has got issues related to environmental or social factors. They may differ from company to company, but no company is perfect. So we think it's really important to have a dialogue with our companies. Our engagement philosophy is founded on this belief or this philosophy that we want to have a partnership approach with companies. We want to collaborate with companies because we recognise that every company can get better. And importantly, we think this also makes good investment sense, because as companies get better, we think that would improve our risk-adjusted returns, also would make better investment performance for us. So one of the key aspects we look for in engagement is a management team that's willing to engage with us. We're not in the business of writing proxy letters or being sort of aggressive or confrontational. We deliberately try to find companies which are open to engagement and want to work with us. So I know the title of this session was the low carbon transition, and I've already said we don't invest in fossil fuels. However, that doesn't mean that we can't have an impact in the low carbon energy transition. We think about low carbon investing in a really strategic way. So first of all, we're trying to avoid the disruption from the transition to the low carbon economy. We deliberately don't invest in fossil fuels, we don't invest in suppliers to fossil fuel companies, we don't invest in fossil technology companies, we don't invest in high carbon emitters. We really think we've got a very low exposure to carbon as a risk profile. And then we try to invest in solution providers, and that extends far beyond, as Mike said, renewable companies. We're looking at sort of lots of different types of technologies, goods and services that are related to the low carbon economy. Now, if we want to solve the problem of climate change, then every business needs to get to net zero carbon. It needs to decarbonise. And this is where one piece of our engagement has been focused. So I'm going to stop here. I'm going to pass over to my colleague Anna, who's been doing a lot of our work on engagement. And she's going to talk more about what we do in terms of low carbon, and also another engagement example in relation to improving environmental and social performance.
So I would start off by saying that we have a fairly unique way of how we look at engagement. We start off first by recognising that we are not the experts in every subject matter relating to environment and social. And that can be sometimes quite tough because Hamish has been doing this for a long time. I've been doing this for a long time. My original background is in environmental science and I'm a chartered environmentalist, but I'm not an expert in everything. So when we look to engage, we go to the people who are experts. And one of the areas that we've done broad engagement on is regarding net zero carbon. So even though we don't invest in fossil fuels, it doesn't mean that our companies in our portfolio do not have a carbon impact. And we would love them to move towards being net zero carbon, ideally by 2030. Now, we've signed up to an initiative called the NZC10, which has been created in partnership with the University of Oxford and some of the climate scientists working there, which works on engaging with companies to allow them to set targets that are looking towards being carbon neutral based on scope 1, 2 and 3 emissions by 2030. And the reason we did that is because we felt that it would be good to partner with the experts in the space in terms of them making a change in our space. And one of the things that engagement project, which I would encourage all the other asset managers in the room to get on board with because it's really good and it's a good way of framing engagement, it allowed us to actually engage with companies in our portfolio on this to ask them, have you thought about setting a target for 2030 instead of 2050? Is it possible? And actually, we had quite good response from the vast majority of the companies in our portfolio on this when we've engaged with them. We meet the 10% threshold already, but we're looking to go beyond that as part of our mantra for continual improvement. We always seek to improve our portfolio year on year so that our customers actually would not be getting the same quality of portfolio the next year. They'll be getting a better quality of portfolio moving forward. So I'll move on to another form of engagement that we've done, and this is one that was more closely aligned to some of the things that I've looked at personally and professionally, and that is relating to cobalt. So we have this need to transition to low zero carbon. However, we need to start thinking about where the materials for that low zero carbon transition is coming from, and in particular, if we're trying to transition to the photovoltaics that Mike mentioned or some of the other renewable technologies, a lot of these are fueled on lithium and they're fueled on cobalt. Where does cobalt come from? Well, 2/3 of the world's cobalt is coming from one country, and that is the Democratic Republic of Congo. So it's not good enough just to say we're going to transition. It has to be a just transition. And one of the things that we look at is trying to work with companies in our portfolio on minimizing the social impacts associated with their technologies in regards to cobalt. So we started working with Microsoft last year on this, and that was in part because some of our customers were concerned about this. It was also in part because it had been raised as an issue by Amnesty International. But before we even worked with Microsoft on that, in line with our investment approach, we started engaging with a charity that specializes primarily in children's rights. Because one of the areas that we were really focusing on was trying to remove child labor associated with cobalt. Now, we can't name that charity, and there are various reasons as to why we can't do that. A lot of it is actually to do with reputational risk to them, because they're concerned that if they're seen to be working with investors or they're seen to be working with mining companies, they won't get the contracts and the additional money that they normally get to actually practice. Sorry, I will wrap up, I promise. That engagement with Microsoft was really successful, and it led to them writing a report called The Devices Sustainability at Microsoft at the end of 2018, and that report was recognised by Amnesty International as a massive milestone in terms of the work that they're doing. And we're still working with them now, but it's an ongoing issue.
Brilliant, thank you very much. So thank you to all of our presenters. You have a chance now to ask some questions, so feel free to jump in. Lady,
that story is beautiful, of the DRC and charity. How can we get these stories out to our investors? Because as a retail financial planner, we get so bogged down with like risk-targeted performance, attitude towards risk, putting your clients in the right perspective funds. But clients love to hear these stories, and so one of my criticisms of fund houses is you don't communicate enough these stories from the back rooms of the analyst desks. So can we have some voices of the analysts and some stories getting out there, please?
We take that on board. I can only speak for Janice Henderson. We release a quarterly engagement report to all of our customers where we actually communicate these stories. I can't speak for the rest of you guys, so I'm sure that you guys are doing similar things.
We do. We have a stewardship report, which there are some copies just over there. We also have a house report, which is quarterly. The stewardship report is slightly less frequently, but we certainly do communicate the engagements. We're also in the press a lot, which helps.
Yeah, there is a lot of information on our website. We do a review every year that kind of summarises all the stuff we've got up to, which I think is a useful way of communicating it. It's very hard to explain to someone in 5 minutes all the stuff that you're working on. We do write a lot of articles, but I think the trick is probably not on the platform or whatever there's not really any information on there. But if you go to the fund manager, the asset manager that's running it, there's quite often a lot of information there, but I do accept that there could be more and it could be more exciting, and that it's not always obvious where it is.
I would perhaps add as well that I don't know if you would sympathise, but we do have an ongoing, I'd say, should I say, use the word battle with our compliance department on the amount of information that we can release. So it's not for lack of want, but often, unfortunately, one of the biggest trends in our industry over the last 5 years has been increasing regulation, and that has limited our ability in some instances to communicate how we would, perhaps naturally want to communicate with our investors.
I think the lady on the left has a question.
Hi, it's a collective question as to how you raise your prominent voice rather than individual firms. How do you demonstrate to mass market consumers that sustainability and impact funds as a whole rather than your particular fund?
Sorry, can you say that again?
How are you educating and raising your prominent voice as a collection of sustainable managers? Or don't you think that's enough?
Might I just urge our panellists to keep it brief, because I think
really brief.
Questions on the floor.
I spend a lot of time going around the country getting people to get CDP points about sustainable investing and how it works and the different themes that are going on. So we do a lot of that. I think it is important. I think a lot of it is a matter for, this is a new thing. It wasn't on the curriculum when a lot of these, we were all at university, and so it's important to get up to speed. And we also have been working with the CFA, the Chartered Financial Analyst Brigade, to get them to include it more in when analysts get trained, as well as going to universities and speaking to sort of MBA students in asset management. So we do quite a lot, and I think Uxif do quite a lot.
Yes, we do
as well.
Brilliant, thank you. Just conscious that we're coming up to time, but gentlemen at the front.
Thank you. It's very noble hearing all these speeches. The challenge I think that I'd like to get your view on is that as an investments industry, as companies such as yourselves, can't handle your cake and eat it, because you obviously are talking about SRI investing, you have colleagues that are investing in fossil fuels, etc., and things that are harming the world but are deemed to be seen as profitable. How do you see that journey going within the companies and the journey to get to
I think there's a lot of pressure for the asset management industry to take a little bit more responsibility for exactly what you're saying. And I think although it's slow, I think everyone, even if it's reluctantly, are dragging their feet, because if you want to pitch for an institutional mandate, if you're not an active member of the United Nations Principles for Responsible Investment and come out not as really terrible because you get ranked, you don't get face time. So I think, you know, it's happening slowly. I'd like to see it happening quicker, but you know, we are advocates for including environmental social governance into it, even in other parts of our business. And I think what's really helped is actually the success of our business. So we've delivered very competitive returns versus conventional peers, and we've gathered a huge amount of assets, and it's showing by example that this is a grown-up, very effective way of investing. And actually, by not getting your head around those two sustainability bets, you're investing blind and you're probably not going to make it.
I'm quite happy to also add to that. So something that I tend to do, well, I've been doing for the last couple of years, is that I've been going into schools to teach sustainability. And the reason I do that is because actually it starts right when they're very, very young. So I've started all the way from nursery and gone up all the way to sixth form, just giving lessons about sustainability. I have a slightly different view to probably the majority of the people sitting on this panel, because I am a sustainability expert by training. I've got an environmental science background, and actually one of the things that I find a bit disturbing about this industry is how few people from my own background are working in this space. So one of the things that I also do is I actually go to my original space, my original background, and I tell them, look, I do sustainable investing, we exist, and this is an industry that can welcome you too. But I think that's the big problem, that actually the industry has been so rubbish at bringing in people from my background to do this type of work when they're the people with the actual academic background in it.
I think we might need to close it there, not least because it's lunchtime. But I thank you very much indeed for